radio for a really great future. We're talking real money.
Yes, believe it or not, we're still here. Yeah, another episode of the Talking Real Money podcast, another hour of the Talking Real Money radio show on Northwest News Radio in the beautiful Puget Sound area. I'm Don McDonald. Tom Cock, of course, is here, even though he's on vacation. That is the dedication of this man. He is on vacation, and he flew back to go to the studio and do the show, and then he's going back to Hawaii. Okay,
Nah, come on. You guys know me better than that. I'm out of here, but we recorded this earlier, so do not call.
Yes.
As the operators are not standing by. So
this program recorded earlier for broadcast at this time.
Yeah. So
you don't know when stuff aired. I mean, it's so funny.
World, who knows?
I watch football games on streaming television. My wife's brother, my brother-in-law, watches them on cable. So sometimes he likes football. He watches a lot of it. And sometimes I'm watching a game here, and he's watching a game there. And Debbie goes, "Hey, did you see? My brother said they just scored a touchdown." I'm going,
no, they didn't.
"No, they didn't."
Which one?
Because I'm like 20 seconds behind them.
Is it really that much? Wow, that's fascinating.
Well, it's the internet lag.
Yeah, okay, makes sense. So that's interesting. So
nothing is real anymore. It's all an illusion. Just live with it.
Yep.
But the one thing that we are is we are talking real money. That is real money talk. And we want to try and help you make better decisions. And one of the places where we make dumb decisions is when it comes to trying to make money quickly and in large quantities. When we get greedy. And the current Chief Executive Officer or CEO of Charles Schwab has some very strong opinions on that score.
Yeah, I'm loving it. Rick Wurster, I believe I'm pronouncing that correctly. Yeah, okay.
Not Bester, Wurster.
Yeah, Bester Wurster. I really do appreciate what he said, but I will take a small grain of salt with this because I'd like to see where we are in 2 or 3 years. Because as you know, other people in this industry said, well, we'll never do that. And then who's the guy who runs BlackRock? I mean, didn't he say that about crypto? Now he's running around the neighborhood telling everybody they need to own crypto. But Charles Schwab has decided that, no, they're not encouraging you to trade on cryptocurrencies or zero-day options or prediction markets. None of that stuff. In his own words, says Rick Wurster, there's really a bright line between investing and gambling. I really worry about the message that's being sent to young investors that you've got to get these quick hits. Now, on the other side of the avenue is Robinhood, of course. Now, Robinhood is encouraging you to do all these things. In fact, their CEO says they compare it to circling a racetrack where a machine can make all the difference. Trading, says Vlad Tenev, is high stakes and one of the most intense lifestyles out there. Well, I believe that. For sure. It could be very intense.
You know, when you watch old movies, like from the 30s, 40s back then, there was always, in a lot of movies, there was that guy who had a propensity for playing the ponies. And they were always the high intensity, got the racing form, and they're just, because that's what gamblers are. They're high intensity. They're a little bit crazy. Sorry, gamblers, but you are.
Yeah. And that's what, by the way, Robinhood, as you well know by now, right, you can play the prediction markets, trade cryptocurrencies, and they're going to be putting up sometime soon a social media feed within the app so that you can see what the Kardashians are doing at that moment to fix your portfolio. Very important. And Wurster makes a very good point. First of all,
Wurster makes a bester point.
Makes the best. People don't understand generally how much risk they're taking, and he points out very wisely, I believe, hey, it could be at the end, but we've been in a 3-year strong bull market. Things have only gone up. Wait till you're in these weird things that can go down. Well, we've already saw that in crypto, certainly in the last 2 quarters of 2025, right? And here's the part that I absolutely hate about this industry. That's usually your line, Don.
Yeah,
but Steve Quirk, who is among the execs at Robinhood, says, we're rolling out more assets and capabilities to people. That's what they want.
There's a word for that. It's called pandering. You don't... I know Tom, for example, if you set a table and you put out vegetables or a chocolate cake and you said you can eat all you want of either one, Tom would want just the chocolate cake and the bourbon. Chocolate cake and the bourbon.
Not to necessarily mix together, but
no,
close
not together. Although a chocolate bourbon could be pretty good.
That's pretty doggone good. Yeah,
I don't know. Could be tasty. Or it's vegetables and water. You know?
Yeah. Easy comparison for me there. You're right. So,
yeah.
Anyway, this is telling, and this should be telling to you as an investor.
What should it be telling you?
It should be telling you stay away from, because I've not ever been a fan of Robinhood. They keep making these decisions that I think are exactly that, pandering, simply for sales. They do a lot of other things business operation-wise I don't approve of, but they're growing and growing rapidly, and the number of trades grows rapidly. And we know the people that trade more and the people that follow these things generally end up with less.
And, your mother probably told you when you were a child, don't play with your food. Well, let me tell you something even more important than that. You can play with your food all you want. I don't care. Don't play with your money. Your money is your future. You may not realize that in your 20s. Well, you should, but you may not. Your money is your future security, and it is not a toy. Put it down and take it seriously. And please don't throw it away on gambles. We'll be right back.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Through the magic of modern digital recording techniques, this is Talking Real Money with your hosts, Don McDonald and Tom Cock, who's currently in Hawaii, but is here with you right now.
Just be glad you don't have to. You can hear me, but you don't have to see me in the grass skirt. That's the part that works well for you. So,
do you? Oh, without the bourbon you're going to be drinking, you probably will be in a grass skirt.
But only for part of the day.
With a lampshade, just like a nice 50s movie.
They'll drop me somewhere in the middle of the Pacific if I have it on too long. So,
And going forward from here, don't call us today if you're listening to the show on Northwest News Radio. Don't call. We're not here. But if you want to ask us questions, go to talkingrealmoney.com and speak your question into your computer or your phone, and it'll record. Or type it in, and then Tom will get it. But here's one of those that was spoken into whatever the device might have been. I think it was probably, judging by the car noise in the background, is probably on a phone.
Good morning, Don and Tom. I have a question for you about a 401k plan. My current employer has decided to change companies that will handle our 401k plan. Am I able to remove the funds from the existing fund if I'm less than 59 and a half and put it in a Vanguard, Fidelity, or Schwab account outside of the 401k? I'm thinking a direct IRA rollover because they're changing companies. I'll continue to be part of the new company with funds in the future, but I want to know if I do have an option as an employee that is not 55 or 59 and a half to remove those funds that I currently have and do a direct IRA rollover into a Vanguard, Fidelity, or Schwab account. Thank you.
So the question is, can you take the money out of your 401k even though you're still going to participate in it? It's just they're changing custodians or administrators, and so they've changed the rules a little bit, and I want out. I want to go to Vanguard. Do I get special dispensation to take it out and move it in service? It's an in-service transfer.
Yep.
Is that the way it works?
No, that's not the way it works. I'm sorry to say, because if you're going into a plan that you don't like the options, I just looked at one that was horrible. Not only poor diversification, high cost, et cetera, actively managed funds, and no index funds, which shocked me. So in this case, I had to say just go on the target date fund. So no, that would be the problem. And going back to that, many times, if the new plan does have those poor options, high expense, then your best option is to use a target date fund where you can usually find something at least reasonably priced when it comes to the expense ratio. But no, you get no special dispensation by the fact that they're changing plans.
Yeah,
Sorry to say.
There's no rule that says, well, okay, if they change things, you can get out. No, it doesn't work that way. Yeah. Now, if they allow in-service transfers, that's a plan-by-plan thing.
And that's generally after 59.5, even with major companies that offer this. We've seen Boeing still does it, I believe. There's others, major corporations where you can take the money out, do a direct, as you said, direct transfer, so you're not taking the money into your house and then
I really want to. I want to work on the how we define these terms.
Yep.
Yeah, because a transfer is technically when you move the money from one place to another place and don't take possession of it. It doesn't go into your bank account. You don't get a check. A rollover, at least has been for most of our history, a process whereby you have the money sent to you in a check or moved to your account electronically. Then you have 60 days to roll it over into an IRA or another 401k without taxes.
The former is the better, right? Because there's no possibility of things going wrong. There's no possibility of you having the money for more than 60 days where then it gets messy. So, but the challenge here is, again, moving from a plan that perhaps you liked to a plan that you no longer like. You're just out of luck there. I mean, so the only thing you could do then is wait until, well, first of all, check to see if at 59.5 you can do what you referred to as an in-service distribution, even though it would still be moving to an IRA, because then you could take the money out of the plan and move it to an IRA. But that's not in every plan and usually main corporate, but that is what it's called, in-service distribution.
Generally speaking, these bad plans that we see from time to time are plans from smaller employers.
Yeah.
Because the smaller employers get misled by a friend, an acquaintance, a golf buddy, somebody at church who's selling really expensive commissioned products and high cost administration and bad choices. So if you here's one of the things you as an employee might want to do. If you have a great relationship with your employer and you're not going to get fired for complaining, talk to them about their fiduciary responsibility. They have a responsibility to provide you with the best options they can get, not just with the first person who comes along. The other thing you might do, and I've seen this work with some mid-sized employers, is to get together with a group of other employees, talk about the downside of your plan, and get them together in some sort of a petition or a letter writing campaign to encourage the employer to provide better choices, because not only is it better for the employees, but in most cases the employer is also participating in this plan and probably doesn't realize how bad the choice is from that friendly neighborhood broker they're dealing with. They may not know.
They may not. And
my guess is they don't know.
Yeah, I think you're right. They're misled and they don't understand. But at the very least, by the way, it costs them nothing to just add a few index funds. That's what I tell people. Tell them to add a few Vanguard funds, for example, or Fidelity funds, because those are available. Most plans can add them, but because the broker has sold them into something else, not nearly as good.
Or have them listen to our show. You just say, go listen to Don and Tom, or give them a call, or whatever it is. Send them a question, and we'll be right back after this.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
We love when we do the Saturday show, one of our favorite things is taking your questions. But if we're doing the show and we're not live, we've recorded it in advance, like this one, then you can't call us live. So we have to rely on all of you who have sent questions in at talkingrealmoney.com on the contact form. And Tom collects these. He's actually wallpapering the guest house at his home with just it. Actually,
you're gonna love that when you come and stay.
Really fun.
That's a good idea.
There's no other entertainment out there. You just read the walls.
I'm going to do it and not tell my wife. She never goes out there. She'll never know.
And it'll add a layer of insulation to keep it from getting so cold. Little air gap between the paper and the wall.
That's smart.
What have you got
really great idea.
in questions that are becoming wallpaper?
A lot of good questions. This one comes from St. Louis, Missouri. Tim writes us, and I'm sorry to see that Missouri is losing its football team.
Oh, come on. They're not really
but,
losing it. It's like
but isn't it moving to Kansas or something?
Yeah, I used to live. I mean, it's like the same thing. Come on.
But it's the pride of the thing. Like, they're leaving us, they're moving anyway. So, okay, any chance I get to pick on the Chiefs, I'm pretty much going to do it. You can count on that. So I do apologize for that up front. It says, hi there, Don and Tom. My wife has two funds to choose between. FAGKX. FAGKX, that's the Fidelity Growth Company commingled pool Class O. This one has 602 stocks with a 35.35 expense ratio. The other one is the Vanguard Fiduciary Trust Company 500 Index Trust. Couldn't locate the ticker. This fund has 519 stocks, an expense ratio of 0.11.
Oh, zero. Wait.
Quotes,
0.11? That's high for Vanguard.
0.011. I'm sorry.
0.011. What was the Fidelity Fund again?
Yeah. FAGKX. Now, he does say the FAGKX has been around longer, has much better past performance, pointing that out. Which do you prefer? I have accounts at Fidelity and would like to get a couple of Vanguard ETFs. Do you see any issue with them getting them through Fidelity?
I got to tell you, I would not. I don't like the whatever. FAGKX. I don't like the fund.
Fidelity Growth Company. It's probably
actively managed. It leans super growthy, but it's mid-cap growth, so it's more aggressive growth. It is a small portfolio.
He does say it has 602 stocks, which
I'm looking at 146.
That surprised me when I read that, because normally they wouldn't have certainly as many as the 500 trust.
That's not true.
So
it's not. So
he must have misread something there. And we wouldn't care, by the way, about the performance. And I know people are going to be surprised to hear that, but we're not judging the fund on that, because that could be luck, could be a variety of factors.
This fund is performing well because it's very aggressive. It's really aggressive.
In what regard?
They're smaller company growth stocks, so they're in the right arena. They're in growth. They're growthy. And I mean, 2024, they're up 27%. I mean, 2024, they were up 27%.
We don't have the
year to date is almost 16.
And this is as we have mentioned, does not include the last week of December, because this program has been recorded. Do not call. No operators are standing by. So the performance wouldn't be as important to me as the portfolio. As you said, Don, it's more aggressive. It's 3 times as expensive. So I would. And by the way, here's the other thing to think about. These are two different funds, right? One's the S&P 500 basically, and the other one has some small in it. It's more growthy. So they're not the same. So it's important to measure the asset class as well. But if I had to pick between them, I'd pick the 500 Index Trust, pay that low expense ratio, and get decent asset allocation, diversification.
The expenses are about 60 times higher. 60.
I had 0.35. He says 0.35 and 0.011. Thank you. You're right.
And this one, the expense ratio, according to Morningstar, this is the Class K, so it's the same thing.
Yeah.
Morningstar says the adjusted expense ratio, so he must not be looking at the whole thing, is 0.68.
He says Class O.
Well, then that's not FAGKX.
Yeah, he says commingled pool class 0. And the last pool class I got, that's what I got too, was a 0. So I get it. But again, even without that, it added another 30 basis points you just put on top of that, Don. I would still pick the 500 Index Trust with a very low expense ratio and better diversification.
Not great choices, by the way. Kind of weird.
Well, no, you're going to need small value. You're going to need international. There's a whole bunch of other things you're going to want to add to that portfolio.
Oh, my gosh, we're out of time. We'll be right back.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Hello again, my friends, and welcome back to another exciting edition of Talking Real Money with your hosts, plural, Don McDonald, that's me, Tom Cock, that's him. We're here on tape, live, not live, barely alive, kind of alive, trying to be alive on tape. talking to you about money.
I think we could use the expression live on tape would be okay.
Lively on tape.
Oh, very lively. Yeah,
We're much more lively. Indeed. Today, you need to know something about. I'm gonna make the radio stations mad.
You're going to make anybody mad who doesn't like change either, by the way.
Yeah. The world is a changin', and you can participate or not, but you're going to find that more and more really good content, audio content, is only going to be available to you through podcasts.
Ooh.
Radio is changing. Well, and music radio. Look at music radio. I mean, if you want to listen to, we're talking talk radio now.
Yeah, because
music
you spend
radio.
all day talking about that.
Yeah. You should go on Spotify or Apple Music, and you've got everything in the world at your fingertips. But no, we want to talk about spoken word, talk shows like this one. Radio is a place. I'll give you an example. We pay a lot of money to be on the radio in Seattle. I hate the fact that we do. I loved it when I got paid to be on the radio. When I worked for KVOR or KOA or Business Radio Network, I got a paycheck for being on the radio. And then the industry changed. And now financial talk shows have to pay to be on.
Yeah, I don't think there's any financial talk show that doesn't.
Dave, but there's a roundabout revenue share for some markets.
Money, yeah. Mm-hmm.
But generally speaking, most of what you hear, including the show that follows ours on Northwest News Radio, is a paid infomercial. Yeah. And the one that follows us is really obviously infomercial. We tried to make our show contentish. But there are a lot of great money shows. If you want to listen to good money shows, there are tons of them in the podcast arena, including us. You can listen to 2.5 times the content if you learn how to use podcasts. So this is a podcast listening primer. I, again, am going to just use the big ones because I think that's what you ought to do. You're going to find it much easier. If you are on Apple products, Apple Podcasts is built right in to the Apple infrastructure. It's a very robust means of listening to podcasts. If you are on Apple or any other place, Spotify has a very good podcast product. So
good being defined as a lot,
a lot of content, easy to get to, a very robust player. There are others, there's iHeart. There are probably about 500 podcast apps and services out there, but most of them.
Spotify and Apple are the biggies.
Yeah, I mean, when you look at our numbers, in fact, I'll just give you. I've got them right here.
And by the way, we thank you for listening to the podcast because at the end of 2025, the last time I looked, we were still somewhere around the 50th most downloaded investing podcast in the entire world. Just little old Don and Tom. So we really appreciate it.
Yeah, let's look at talking real money. In the last month, 46% of our listeners come from Apple Podcasts. 10% come from Spotify. 9% come from iHeart. 5% come from Overcast. 5% come from Chrome. Then Pocket Cast, Podcast Addict. Amazon Alexa's way down there. Amazon's way down there. Wow, that surprises me.
Which used to give us a very high rating, by the way. Amazon did back in the day.
Here's the thing.
Yeah.
Apple Podcasts is, if you're an Apple user, it's the go-to. And so let's start with that. Again, this is an app that is on your phone. If it's not, go to the App Store and download it. Apple Podcasts.
So you go to the App Store and download
Apple Podcasts.
Apple Podcasts.
Apple Podcasts.
So it has its own app, and then you can click on that.
And it has a purple button with a little kind of person-looking thing with a couple of circles. Mm-hmm. And then that is an app on your computer or on your iPad or on your iPhone, and you open that app up. It's really easy, and you'll be on the home page if you've never done anything. And then what you'll do is you'll type in in the search, there'll be a search button or a search bar, depending on whether it's the phone app. Let me bring up the phone app. Phone app or the Mac app. And the phone app, the iOS app is pretty traditional. So there's a little, in the lower right button on the phone app is a search button. And you just type in Talking Real Money. Talking Real.
And then voila, there's 1,800 podcasts to listen to.
Right. So we're right there. The latest
Crazy.
episode immediately comes up.
It does.
It's right there. There's a button for the latest podcast. Okay? You click on that, you listen to it. Now, you can listen to it through earbuds. You can listen to it through the speaker on the phone, which is actually a really good speaker, or on the device, whatever that might be. You can also get a USB cable and plug it into most cars and use a service that is built into most cars now called Apple CarPlay. And that turns your screen into your phone, basically. And you can listen to podcasts on that. So this is one of the ways you can hear a lot of our stuff really, really easily. It is not hard. I know it's scary, but try it out. Just try listening to it in your house on your phone. And we'll be back right after this.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Welcome to 2026 and Talking Real Money, the first show of 2026, I think. No, we've had a recorded show. That's right, because I did
Well, it was the first radio program.
First radio program, yeah. I did a Q&A, but other than that, yeah, we're right here at the beginning of the year.
Yes,
Thanks
we are.
for being with us. And join us. We'll be live next Saturday on Northwest News Radio and, of course, on the podcast all the time. We do 5 podcasts a week. So there's a lot more stuff via podcasting and a lot more questions getting answered. And we try to keep our podcasts no longer than about 35, 40 minutes.
No longer than 30, I think.
No. The Saturday shows, when they get edited down, become 36 or so.
Okay, that's true, because I don't look at the time there. But on the enterprising ones, those are between 25 and 30. So
yeah, pretty
you
much.
can walk your dog or do whatever. Yeah.
If I don't have a lot of questions, the question and answer ones can be like 20.
Yeah.
Depends. All right, so now we're going to do more questions. These were sent in at talkingrealmoney.com on the contact form, and then Tom gets them, because they typed them, and Tom gets them on a piece of paper.
And I continue my war on trees with this, so it's great. Get to print them out and everything. So Michael writes from Vancouver, Washington.
The Lorax is going to be mad at you.
Oh, looking for me all over the place. I thought I heard you guys say that if a person wanted to be more diversified, they could own half Avantis and half Dimensional, because they pick up different types of companies, small and value. But I heard you critiquing someone's choices recently who had 2 different ETFs because there's a lot of overlap. Would it be extra diversification to diversify between Avantis and Dimensional?
Okay, maybe a little. They're not much.
Yeah, let's just a step back.
Yeah.
They both offer exchange-traded funds. Mm-hmm. They both offer there's a little, we'll talk very briefly about the difference in products, and they both are of a similar price. Avantis has an approach that is, any way you look at it, they own fewer stocks. They're more concentrated than Dimensional, I think, on every portfolio too, by the way. The way that they build the portfolios, the way they eliminate certain companies, they're not as diversified. So there's a little difference. Remember, from where they became, Avantis was a group of people that at Dimensional, when Dimensional decided purposefully not to offer exchange-traded funds, it was a business decision. And the people that left said, well, you should be in the ETF business. This is big business. And boy, was it ever in 2025. So they decided to split off and do their own thing, and that's what happened. The question is, in operation, I would not own, for example, if I had a portfolio and I want to be globally diversified and it's a relatively small amount, I would not own the AVGE and the DFAW. I think that would be a silly thing. But here's what you could do. Here's the way I would look at it. If you're going to build a portfolio of funds that is going to have emerging markets, and it's going to have U.S. large cap, and it's going to have U.S. small cap value, all those things, you could then split them between the Dimensional products and the Avantis product, but I wouldn't own the same asset classes. And again, I don't know what difference that's going to make truly in the long haul. Probably not a lot.
I got to tell you, this
It's a lot of
whole
work, too, by the way.
Yeah, it's a lot of work. And again, I think we're really getting into minutia. We're getting into the weeds. I wouldn't, boy, I'd have to do some real digging because it looks to me like Avantis may have more than
More
Dimensional.
stocks.
Yeah.
Interesting. Okay, because
Because
last time I looked, they didn't. Yeah.
Avantis is made up of 10 different funds.
But they have more than 10 ETFs.
They have in AVGE.
No. Oh, I was speaking in a general sense.
In
They have more
AVGE,
10. In AVGE, they own 10. Yeah, okay,
10
that makes
ETFs.
sense. Yeah, right.
In DFAW, they have 5 ETFs.
Yeah, but what we're talking about here is the number of stocks.
But even then, when I look at these portfolios, it looks like there's better overall diversification, possibly. And I'd really have to dig deep to make a final determination. But it looks, again, I don't think there's enough of a difference.
No, I think if you're going to look back, in the next 10 years, there's not going to be a huge difference in performance. The operation of the funds is slightly different, but probably at the end of the day, you could pick one fund family and you'd be fine. Again, when we manage money, we use both. But you got really smart people in Connecticut that are making these decisions. Spend more time on it. So
right, you've got people who are working to do this, and most individuals won't. And it's so funny to look at the performance figures because DFAW hasn't been around as long, but when you look at their numbers, they track almost exactly over the short period we have. It's just so close as to be. Again, I think as human beings, we've got this advantage/disadvantage of this big brain, and sometimes we feel like we need to use it for things that are counterproductive, and over-diversifying is counterproductive. And
over speaking is over speaking.
No, we still have time.
Oh, okay. So
see, this is why
I'm sorry.
You are trying to do it on a clock, and that does not work. You have to actually look at the recorded time.
Watch, yeah, I know.
Yeah. So here's the thing: behind the
above
scenes,
my pay grade.
I am trying to make these without editing them fit into the segments.
Yes.
Before the commercial breaks and the traffic breaks and all those things. It is easier than it used to be. Because it used to be the brakes floated a little bit.
Yes, they did.
At Northwest News Radio. Now the brakes are hard, and that means they go at a certain time, unless there's a glitch. And if there's a glitch, well, there's not a darn thing we can do about it. But we will be back with more if there isn't a glitch in just about, I don't know, I think it's about 3 minutes or so. So you can stick around for that. I'm Don. That's Tom. We're talking real money.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
We have more show left? Oh, we do. Look at that. We still have about 3 minutes left in the program for our first show together of 2026, even though Tom's not here. It's a miracle, ladies and gentlemen. It's a New Year's miracle. I can't say Christmas miracle because Christmas is over.
It's done.
And
pretty early.
Good riddance.
Yeah, I knew that was coming there. Humbug. Yeah, got
riddance.
it. Okay,
good riddance. Yeah. I'm sorry. It's just.
No, you're not. No,
it's
you're
every
not.
year. It's too dang stressful. The expectations are high.
The two of you sitting in your house, that was a lot of stress for you.
No.
This year,
No. It's not that part. It's not that part. It's that it's the time of year when a lot is expected, and my wife has very high expectations.
Well, that she does.
Of herself, and so if it doesn't
isn't it that time of year when the world falls in love? Isn't that what the song says or something?
I thought that was Valentine's Day.
No, that's what anyway. That's going back 60 years. So
they only fall in love because the weather outside is frightful.
Yeah, very much so. And, boy, has it been here.
They need a big hug, but
yeah.
Anyway, excuse me. We're in a new year,
yes. Huh? You were saying
we're in a new year, and it's a new opportunity for you to try to get your financial life together.
Yes.
So what we'd like you to do is sometime here in the new year, really look at your situation critically. Don't you've been looking at it haphazardly, I think, most of you. And you need, even if it's not a hard and fast, you bought it financial plan. Tom says this all the time. You really do need a plan.
Yeah, you got to start with the plan, Don. Yeah,
tis
always.
the season to be planning.
That's true. Indeed. Leave the laws out of it. But yeah, you got to have the plan. And here's the other part that I'm going to hear this year, because I've heard it the last couple. Oh, I made a lot of money the last few years. Yeah, pretty much everybody made a decent amount of money. That has nothing to do with how your portfolio is designed, how much you're paying others, how much risk you're taking. That's the other part of the equation that people have a tendency to forget. So, yeah, get some help with that. Plus, by the way, we're going to be speaking in person at Retire Meet coming up March 7th. So take advantage of that.
We moved it to March.
Away, so.
We moved it to March because we're hoping for better weather.
Praying for better weather might be
2 weeks later might make the difference.
It's going to make a lot of difference.
Doesn't spring start in March?
No, I think it's...
it's March.
Yeah. Okay, we'll go with it. Yeah, sure. Why not?
It's like 2 weeks before spring.
Oh, absolutely. The flowers will be coming out. It'll be sunny, 70 degrees. Come
and everybody wants to vacation in beautiful downtown
That's at
Bellevue.
retiremeet.com. But if you want help directly, you can go to talkingrealmoney.com and get our help there. So either way.
There's all kinds of .coms that you can go to.
Shockingly
If you want
enough.
tickets to Retire Meet, or if you want to attend the virtual event, just go to talkingrealmoney.com and get those. And if you want some help with your money, we will actually provide you with the services of one of our fee-only real-life fiduciary advisors without a fee and without a high-pressure sales pitch. Again, just by going to talkingrealmoney.com and then clicking on the button that says Meet an Advisor. If you have questions that you would like us to answer on future podcasts or radio programs, you can also send us those. Same place, talkingrealmoney.com. Just look for that Contact Us button. It's in the upper right corner. And then either speak your question into your microphone or type it up for Tom.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.